Good afternoon, everyone. My name is Brad Blosser with Core Marketing, and I'm pleased to have this presentation today. I have a lot of passion when it comes to long-term care planning. The vast majority of clients out there are the ones that have initiated the long-term care purchase, not the advisor. I can almost promise you everyone on this call either knows someone or has a family member that has currently received care. National Guardian has a unique story. They are a traditional carrier, which I know that's rare nowadays. But one of the great points about that carrier is there's no legacy business there. They have available limited pays, single pays, return of premium. There are some unique opportunities to fund these policies in a tax-favored basis. And I invite any of you that have any questions, have any cases you want to discuss, call either myself or Core Case Design. And without further ado, Mark Glickman.
I appreciate it, Brad. Thanks so much for hosting this webinar on a very important topic, which is long-term care planning. I hope many of you out there are attending it because you're looking for solutions for your clients. My name is Mark Glickman. I have a unique background in that I'm an actuary in the insurance industry, meaning that I'm one of the guys that help price the product. I can give you kind of a unique insight into why offering a traditional long-term care product is safer today, both for the client but also for the insurance company, and yet still a very good value proposition. So I'll be going through some sales ideas today and using National Guardian Life's new product for both 1035 exchanges, but also to help the live, die, quit story if you're familiar with hybrid plans. And the key thing to remember is that a solution is really specific to the client's needs. And today we'll be talking about ways to offer both traditional but also hybrid solutions so that your client can determine which one is a best fit for them. So very briefly, as Brad mentioned, NGL has been in the marketplace for a few years now, but doesn't have any legacy long-term care issues. So it's really a fresh start with long-term care. We're looking to release this nationwide. So the product is currently available in 47 states. California should be our next state release in the next 6 months or so. And we're even filing this product in New York soon. So we hope to have this available in most of the states where you guys are located. We are also releasing a new worksite executive carve-out program for long-term care. We won't cover that today, but if you're interested in tax deductions for business owners and key executives, this is a great solution for doing that, which is unique to traditional long-term care as well. And we can always do a follow-up call or webinar on that topic. Partnership, LTC partnership is an important thing to think about in terms of if you have middle market clients that might want to prevent themselves from spending down all their assets for Medicaid. There's a way that you can buy long-term care insurance and get to keep your assets even if you need to become a Medicaid recipient due to a long-term care event. We do have an electronic application that we've released, and we're going to be releasing that nationwide. If you want to hear any of the webinars on the product, we have recorded webinars, and we're even doing a production bonus if you're new to the product and you're looking to get on board that can help financially incentivize you to take a look at the product as well. So just very briefly, it will be a bonus if you submit and place 3 policies in the summer months between May 22nd and July 21st. We'll actually pay an extra $1,000 if you're eligible for it through your account with Core. So what I really care about today, though, is getting your clients a long-term care plan. So today we're going to talk about how to open up the conversation, how to incorporate some of these ideas in terms of funding a long-term care plan into the conversation. We're going to talk about what is a 1035 exchange and how it applies uniquely to traditional long-term care in addition to the hybrid products, which you may already know that do 1035 exchanges. We're going to talk about this concept, which is called live, die, quit, which essentially means that you're doing a long-term care plan for a client, but if they don't use the benefits, they have a benefit if they die to their beneficiaries, and they also have a benefit if they're looking to change their mind or surrender the plan. There's a benefit for that too. NGL, again, has a unique set of features and riders that make a traditional long-term care product and turns it into a similar story to what a hybrid product does today. We will kind of follow that up with how to position some of these ideas with your clients, a couple of case studies, And I'll show you a software at the end if you want to get into the numbers. I'm a numbers guy. I know a lot of you out there, you manage money or investments, and you're numbers people as well. And it's really about how much does this thing cost. We can go into a couple of details and we can send you this software so you can try it for yourself with your clients. And finally, just a few tips in terms of things to be aware of or watch out for. We will be taking questions at the end, so I would encourage you to type in your questions into the question panel or the chat box on the right-hand side of the screen. And at the end, Allie's going to read out some of those questions, and we'll leave some time for that as well. So let's begin by talking about starting the long-term care conversation. Most agents in long-term care have historically focused on the statistics about long-term care, the chances of needing long-term care, and then the cost of care, and they said, well, based on your needs, here's what long-term care costs. And people are under the misimpression that there's a price, a certain price that they have to spend in order to get a plan in place. Well, it's not necessarily the case. We can work with pretty much any client based on their funding source and then their budget to find a customized plan just for their unique needs. So they, historically, they'd be looking at the chances for long-term care, they'd look at the cost of care, then they do the health assessment, the underwriting assessment, they'd present the solutions, and finally at the end, they'd look at financial suitability. Well, the problem with this approach is that we're focused, of course, on solving the potential long-term care need, which is a good thing. However, it's almost always based on the full cost of care, or making an assumption about what the client wants to buy in total benefits. And in a lot of cases, the client is looking for a certain price point they're looking to spend. So what can happen is they can get sticker shock when they get to the solution stage after having spent 45 minutes kind of biting their nails and worried about what this thing is going to cost. Finally, they're presented something and maybe it's beyond what they really were hoping to pay for it. And as a result of that, they think, you know what, maybe this won't actually happen to me. Maybe I'm in the 30% of people that don't need long-term care because I'm very healthy, and therefore they say, I'll just self-insure, which sometimes is a euphemism for, I don't want to pay for this, and therefore I'm not going to form a plan. Okay, so we're going to suggest a little bit of a different approach, and it works very well with clients, which is to start off with the number one objection about long-term care, which is, I'm worried this is going to be too expensive, the product itself. Remember, it's human nature that people are always willing to self-insure a problem that they don't think will actually happen. So again, they're not saying that they don't want insurance, they're saying they don't want to pay for something where they think, I don't know if the value proposition is there. So what we will say is, and I know this is going to be a shocking statement, it's okay to agree with your client. If they think they're in the 30% of people that won't have this, it's okay. In fact, tell them the risk of this happening, maybe it will be zero for you. Because for everybody, it's either going to happen or it's not going to happen. But let's say it's zero. But if we're wrong, the consequences of you and I being wrong could be devastating to your family. And long-term care is very much like life insurance or disability when you're offering it, is that the main motivation for people getting a plan is oftentimes not for themselves, but for their families. And when you ask them to share their personal experiences, you'll find out that the reason they're interested in long-term care planning, sometimes they'll bring it up with you, is that they had to take care of their parents, or they saw the effect on their parents for their grandparents. Almost everybody today has a personal experience. And the motivation is, I don't want to end up causing my kids to have to take care of me like I had to do for my parents. So the key point is that as long as you help everyone understand that they need to have a plan as the primary objective, we'll be able to put something into place. So using this approach, we're going to consider instead a funding approach to long-term care. Instead of basing it on need and cost of care first, let's figure out what's the optimal way to fund the plan. And for those that are financial advisors out there and manage your clients' money, income, or assets, this might be very second nature to you because you might already have a good idea of how the client should be funding this plan. So first step, ask about your client's personal story. It's going to build a relationship and trust that's going to help you through this process, and you're going to understand the motivation. You're going to understand what they're looking to protect. I'll give you an example. My aunt approached me recently about long-term care, and her dad needed care due to Alzheimer's at age 85, and guess how long he needed it for? Until he was 98, for 13 years. So she was concerned about longevity protection, and so I worked with them to design a plan that had much more benefit period protection, longer protection. But again, understanding that personal story will help you ask questions about need. The second step, still very important, even more important than it's ever been before, is to make sure that you or somebody, you can do it with a third party, make sure you understand the client's health. And it could be a 10 to 15 minute, we call it an underwriting pre-qualification, because before you actually apply for coverage, you usually can figure out which carrier will take which health conditions. Again, that's what Brad and his team at Core Group can do for you, is you do not want to submit a case without first assessing health. It also tells you which products to use in the marketplace. The most value you'll get from long-term care tends to be from those carriers that tend to be the most prudent on underwriting, and NGL Essential LTC is a prudently underwritten product. However, if the client is not healthy enough, again, Core Group has a suite of products, not necessarily even from National Guardian Life, that they can offer that accommodate potentially different health conditions. So knowing the client's health will help kind of steer you towards the product that has the best value proposition for the client. The third thing is understanding your client's income and assets. So help your client get to a point at which they understand how they're planning to fund the long-term care problem. If they were going to self-insure it, how are they going to self-insure it? And then you'll have a good idea of what price point you're going to start off with. Once you understand the price point, you take away any conflict between the agent and the client, because that's really the only thing that they're concerned about. Once you both agree that this is where we're going to start with price, then your job can be, well, let me stretch your price, your budget as far as possible. Okay, and there's no conflict there because you're both on the same page. Now, at the end of the process, I would still suggest that you review the cost of care. You might find out that the plan that you designed, 75% covers the cost of care or 50% covers the cost of care. At that point in time, what will happen is the client will ask you, should I buy more? And you can give good advice about, does it make sense? Should they up their budget or not? You know, what is it going to provide as value? But having a partial plan is better than no plan at all. That's the bottom line. So as long as you can kind of follow those steps, that's the approach that we're going to talk about and take today. And we're going to use the NGL product as kind of an example of how to do it. So at the beginning of your presentation, and when you're talking about solutions, once they understand the need for the long-term care plan, tell them that you can help them in one of two ways. We have a product that is a traditional long-term care product where we're transferring the LTC risk to the insurance company, and we're looking at disposable income or assets, meaning that they're not necessarily looking for a return on their income or assets. They're looking for the most leverage, the most protection possible in case a catastrophic event happens to them. Okay, that's the traditional approach, and we'll talk about how to do it, and we'll do it in ways that may be new to a lot of you folks out there in terms of guaranteed premiums potentially, and just to meet whatever the needs might be. But I would also suggest that you also have the hybrid alternative available to them as well. And I'll tell you that a good percentage of people like traditional, getting the leverage, and an equally good percentage of people like the idea of the hybrid option, because it addresses the mentality of, well, I'll just self-insure this. And with the hybrid alternative, it's very easy to show that we can do it with an insurance product, the self-insuring, better and longer than they might be doing themselves. Okay, so the leverage is there on the hybrid side as well, but in this case, you'll get at least your principal back in terms of if you don't use long-term care. So there's really two options out there in the market, broadly speaking. NGL has a product that actually offers both, okay? And we're going to look at a funding approach, and we'll actually do both plans as the options. So don't forget to say, would you mind if I showed you both? It's very important that you don't just show one plan and that you set these expectations early on, because you definitely don't want another agent or advisor coming in with the alternative and having the client come back to you and say, well, why didn't you show me that? Just better to kind of set the stage. Here's the marketplace. A lot of people choose both of these. There's no right or wrong answer, but here's where they might fit for you. So how does it work with Essential LTC is we offer a traditional plan that has riders for return of premium. And simply put, whatever premiums you put into the policy, you get back to your beneficiary if you don't use long-term care. So if you need long-term care, you get a lot of protection in the long-term care component. If you don't need long-term care, the return of premium kicks in, and you get that money paid back to your beneficiaries. And we even have a feature that you can optionally add, which allows you to surrender the plan if you change your mind and get up to 80% of the premiums paid back to you. So even though people know long-term care, they call it use it or lose it, well, it doesn't have to be that way if you include the return of premium riders. And in fact, some people prefer the quote-unquote use it or lose it because they can save that money, or they can put that more money into the plan to get more long-term care protection in that component. So it just gives you more options which to use here, and we'll go through how some of these riders work in a moment here. But first, let's talk about premium funding sources, because again, once you identify how the client's going to fund their plan or self-insure their plan, you can figure out what's the best way, the most efficient way for them to do it. So obviously, people pay long-term care premiums out of their savings. Let's say they have money in a CD, out of their earned income if they're still working, out of their retirement assets like their IRA or their 401k. You can use your HSA if you have a high deductible health plan and HSA to pay your long-term care insurance premiums pre-tax. You can even pay it through your business and take a tax deduction through your business. Again, just an idea and an opportunity if you're working with business owners. Talk to Brad about that, but that's a very good tax advantaged way to fund long-term care. But today specifically, we're going to talk about using your client's existing life insurance, cash value, or non-qualified annuities to fund long-term care. A lot of people aren't aware of this, but the Pension Protection Act, which allows you to move a life insurance product into a life with a long-term care rider product, also allows you to move life insurance or non-qualified annuities into long-term care. So the general premise is that you're just exchanging an old policy that the client may no longer need anymore for a new insurance policy for a need that they have today or the one that they prefer today. And the advantage to doing this is there's a tax advantage, is if the existing life insurance or non-qualified annuity has a lot of tax-deferred gains, with the annuities in particular, at some point in time, they often get taxed on their ordinary income tax in the future. You can actually move the money over, including the gains, to pay the premium for a new policy without tax consequences. It's called a tax-free exchange. So the way it works across different products is you can exchange a life insurance product for a life product, you can exchange a life to an annuity, and you can exchange life to long-term care. However, there's one unique differentiator for long-term care that is not available with life insurance is you cannot exchange a non-qualified annuity for a life plan. You'll see that in the bottom left corner here. You can exchange a non-qualified annuity for a long-term care insurance plan. So we're going to talk about two types of 1035 exchanges today for long-term care, one with a cash value life insurance policy and one with a non-qualified tax-deferred annuity. Both can be tax advantage sources for funding the long-term care need. Now, the key requirement to keep in mind is in order for it to be a legitimate 1035 exchange, it needs to be what's called a like-for-like exchange, meaning that it needs to have the same owners and same insureds on the existing policy and the new policy being exchanged. So that's one thing to look out for in terms of figuring out whether it will work. So again, just to walk through the process, let's pretend that you have an existing non-qualified annuity and it has $100,000 of cash value in it. You are allowed to exchange the principal and the tax-deferred gains, and they come across pro rata. So let's pretend that in that annuity there was $50,000 of principal and $50,000 of gains. You can move that money over to pay a long-term care insurance premium, and we have a single premium option. So you can do it as a lump sum transaction. You can move it over in full with an annuity, or you can even do what's called a partial exchange. So if you moved over $50,000, kept $50,000 in the annuity, you move $50,000 over to pay the long-term care premium, $25,000 of the principal and $25,000 of the gains, because it's pro rata, would come over to pay the long-term care insurance premium. Now, when benefits are used to pay for long-term care when they go on claim, those benefits are still received tax-free. So what you'll see is that $25,000 of gains in the contract that would have been taxed at some point, probably at their ordinary income tax rate in the future, instead are going to fund the premium and will never get taxed. So that's the advantage, is being able to take these deferred gains. If the policy does not have much in gains, of course, you could have just taken a cash out and not paid much in tax anyway. The more gains it has, obviously, the more of a tax advantage you might have today. So that's the general concept for 1035 exchanges, and we'll go through a couple of case studies to look at how it might apply in kind of a real world scenario. Now, before you try to execute a 1035 exchange, and again, Brad can help walk you through this, NGL has in their agent guide a checklist. It's on page 12, I believe, of the agent guide, and it's like 5 questions that they ask you, and if you can check, yes to all the questions, then it will be eligible for NGL to receive the monies. You'll still need to talk to the existing carrier to make sure that they can release the funds on a timely basis and just to help set expectations, but it's obviously in the law for the Pension Protection Act, so generally speaking, it's just a matter of filling out the form and getting the monies exchanged. So let's talk about a little bit about how the conversation might look like if you're talking to a client about doing a 1035 exchange. Now, people oftentimes will have a portfolio, and this is, of course, just a simplified representation of that, where they have a certain amount of investments that they've accumulated over their lifetime. They have, sometimes they have cash reserves, which are good funding sources for long-term care if they would otherwise use that cash for the long-term care need, or a just-in-time, a rainy day fund, if you will, for the needs for something like that. They also might have life insurance and annuities on their balance sheet, and that's where the 1035 comes in. So the idea here is that they might be thinking about their annuity or their life insurance as a way to self-insure the long-term care risk. Instead of that, if they think of it as a funding source to create a better self-insurance plan, what they can do is do the 1035 exchange into the essential LTC product, and what they can end up with is a lot more benefits for long-term care. Now, we can design it, again, with those return of premium riders so that if they don't use the long-term care, we're actually returning that premium that they put into the plan to their beneficiaries as a death benefit. And in addition to that, optionally, you can add a surrender value that's up to 80%, where if they change their mind, they can also get that money back too, if for whatever reason their plans change or they need the liquidity. So while the policy itself doesn't have a cash value, it has a cash surrender option, which allows you to take money out if you surrender the policy. So that's the kind of the live, die, quit idea. Again, pretty simple when you're incorporating with a 1035, especially if you're familiar with this concept with the hybrid marketplace. And the idea when you're talking to the clients is 100% of the time there's a benefit. Whether you need benefits, whether you don't need benefits and you pass away, or whether you want to surrender the policy, you'll have a benefit from this plan. So one of the things that's unique about NGL is it has a lot of flexibility, and Brad kind of alluded to this at the top of the hour, which is lifetime benefits are not available with many carriers, but NGL, again, is prudently underwritten, so it allows us to be comfortable offering an unlimited benefit option. So clients that have that fear, like my aunt did, 13 years, her father needed long-term care, have an option to get unlimited benefits. We also have a variety of limited benefit periods at a lower cost, 2 years through 6 years. And one of the unique features is if you do a joint plan for NGL, a plan for a couple, you can also add on a rider for that, which offers a third pool of benefits. So you don't necessarily need to buy lifetime, especially for couples, when you want a lot of coverage. Let's say you buy a 6-year plan for him and a 6-year plan for her under the joint policy. You can actually add on a rider, which is a very cost-effective rider, to add on an additional 6 years of benefits if they run out of their initial pool, or 18 years of total benefits, of which one of them can use 12 years. So again, there's a couple of different options. It really will depend on how much you have with your 1035 exchange or what their funding source is. There's no right or wrong answer to this. It's really customized to what the needs of the client are. So I won't go too much into this rider or the joint policy design too much. We can cover that. If you have questions about it, feel free to type them into the question panel and we can cover this in more detail. But the concept is that very few carriers out there offer the ability to not have a limited benefit, but then to extend out that benefit for the couple, with this shared benefit being a third pool. And now we've also talked about return of premium, and I want to show you kind of how the return of premium rider works if you want to turn the traditional plan into the hybrid plan. So here's the concept with return of premium. We have one version of the rider, which is called limited return of premium, which simply means that they pay the premiums, and if they have a certain amount of claims that's less than the premium, we return to the beneficiary the balance of the premiums. So we call it reduced by claims paid. In fact, that's how most hybrid plans work. If you guys are familiar with it and you think about it, is most hybrid plans, they'll accelerate your death benefit first, and then if you run out of your death benefit, there are certain products that will extend out the long-term care. So you're using your death benefit first before you get extra long-term care coverage through the carrier. The limited return of premium is a kind of analogous to that type of option. Now, if they end up using more claims than what premiums they paid in, we're not going to have anything left to return to the beneficiary, but of course they're going to get much more value on the long-term care side because they've received much more than they paid into the plan. The other alternative to be aware of is more expensive because it provides more benefits. We call it full return of premium. And it actually is a similar concept, except that it doesn't matter how much in long-term care claims are paid. We always return the full amount of the premium to the beneficiary. They pay a $100,000 single premium, regardless of what long-term care benefits they use, their beneficiary is always going to get $100,000 back. Okay, so a simple kind of idea, but a very unique rider because actually I don't know of any hybrid or traditional policy that actually allows you to have both the premium back and the long-term care claims. So it's kind of a unique thought process there. Now, in addition to that, optionally, I mentioned you can have the option to surrender it. Some people like to add it. Some people say, well, I'm never going to surrender this anyway because my need for long-term care grows. And if you want the surrender option, it costs 10% more to add it on to the return of premium. But what it provides is that option to say, if I change my mind after the 4th year, I get a full 80% back. Kind of vests over the first 4 years. So if they surrender it in the 1st year, it's 20%. The 2nd year, it's 40%. If they surrender in the third year, it's 60%. But as long as they hold it for at least 4 years, that surrender will be 80% for the life of the policy, reduced by any claims paid. So you can't take all the long-term care claims out and then try to surrender the plan. It's reduced by claims paid. So that's kind of the general concept, 1035s combined with this live, die, quit concept. And I'm going to show a couple of case studies here where we look at a couple of examples, and then we'll look at the Benefit Buddy software, and I'll plug in the examples that we did so you can see how you can model these situations up with your clients as well. So we're going to take an age 55 male, we'll call him Jim, and he has a non-qualified annuity, and he's looking to use it as a funding source for long-term care because he no longer needs the annuity. He's not interested in the guaranteed income component. He bought it just for the tax-deferred growth, but he actually has this need for long-term care, and he's interested in what's the most efficient way to fund his plan. We're going to look at that side by side with the Essential LTC plan. I chose a particular plan design that meets kind of the target premium for the annuity, and it turned out to be about $200 initial daily benefit with 3% compound inflation protection for the life of the policy and a 5-year benefit period. So very robust coverage. And I also included that return of premium option, the limited version with the cash surrender option. And the idea is he better off holding the annuity, or is he better off exchanging the annuity for the new coverage through the 1035 exchange? So we're going to pretend that the annuity has $125,000 cash surrender value, and we're going to exchange that for a single premium long-term care policy. Now, when it's single premium, it actually creates a guaranteed premium. So most people, again, think of traditional long-term care. It could have rate increases in some cases. Again, it's less likely today to have rate increases than it was on the past legacy products because it is more conservatively priced. However, there is a guaranteed option, and the guaranteed option is simply by making it a lump sum, you can never have a rate increase. Very simple to understand. You pay the one premium and you never have any more premiums due, and the carrier cannot reduce your benefits. So $125,000 single premium on the exchange. If they don't need long-term care, the annuity may accumulate at about 3%. That's the assumption we used here. So at age 65, they might have $168,000. At age 75, maybe $226,000. With the NGL product, it's a return of premium. So if they don't use long-term care, that money simply goes back to their beneficiaries. They use long-term care to reduce dollar for dollar, less claims paid. Now, if they need long-term care, here's where the advantages are, of course, is the annuity, let's say at age 85 is when most people think about maybe needing long-term care. They have $304,000 in the annuity. Now, in addition to that, the annuity has a lot of tax-deferred growth. So if they're not using the policy to pay tax-free long-term care benefits if they're taking a distribution out of the annuity. In addition to the $304,000, they might have to pay the IRS a tax bill on the tax-deferred gains. Let's say the original cost basis was $60,000. There's about $245,000 of gains, and if they pay ordinary income tax on that, that might be a third, $80,000 check to the IRS. So it just depends on how you're structuring the plan to figure out if there is there a tax liability there. But let's pretend there's no tax liability. It's $304,000. This is the amount of long-term care benefits at age 85 from the Essential LTC plan, $940,000. So over 3 times as much, not including the tax advantage, the tax savings that are possible with this plan. So this is just a single male example. We'll look in a moment at a single female example, and you can also do this with a joint annuity into the joint plan, and we'll have some more options for the joint plans as well, because you can get coverage for both people in a couple as long as they're healthy and they can qualify. So the next example I'll show you briefly, and then we'll look at the software and kind of customize it a little bit, is an age 70-year-old female. Again, people are living longer and they're living healthier. Some of them still need to be thinking about long-term care planning. Let's say that she owns a life insurance, cash value life insurance policy. And we're going to look at an Essential LTC plan that's a little different. It's going to be $150 initially daily, still 3% compound inflation protection, but this is with the lifetime unlimited benefit period. And also I'm going to include that return of premium option, so the live, die, quit story as well. $266,000 cash surrender value in her life insurance policy. We're going to exchange that for $266,000 premium that's going to pay for the long-term care policy through the 1035 exchange. Let's say she doesn't need the life insurance coverage anymore. If she dies and doesn't need long-term care, let's presume that the death benefit is $500,000. Of course, it's going to differ depending on what product she has for the life insurance. The Essential LTC, of course, is going to be the return of premium to her beneficiaries if she doesn't use the long-term care. And when we look at the long-term care benefits, this would have provided a cash surrender value of $320,000 at age 85. Again, the LTC benefits are unlimited. So if she has a need for 10 years or 15 years or a long-term care event, that could be million-dollar, multi-million-dollar type of event. So that's the idea here, is how do we build a plan that's going to provide that peace of mind, and lifetime benefits can do that. So just an example of how it works. In a moment, I'll show you also what the traditional options look like, so you can actually side-by-side compare. Does option 1, traditional, look better for them? Does the return of premium look better? And you can do it side-by-side. And again, it's not really a matter of which story is better or worse. It's which story does the client prefer to meet up with their needs. So before I get into that, just a couple of tips, landmines to avoid. Be aware that if this is a new client to you and you're taking an existing policy and you're exchanging it for a new policy, all of a sudden the other insurance agent, the guy who sold the original policy to them, if that's not you, might resurface, especially when there's a lot of money and premiums and commissions involved. And so just be aware, it might be a good idea to engage with that person, might be a good idea to not engage with that person. Just be aware that that could happen. Also understand that it's important to set expectations with the client, and it's important to be proactive. And again, Brad and his team can help you. Reach out to the existing carrier, explain to them what you're looking to do. For some insurance companies, they're not even familiar that you can do this until traditional long-term care, because there's a unique option here with NGL. They've never done it before. They may want a little bit more details on that. And as long as you set expectations, generally speaking, you can make the process pretty streamlined. But again, the carrier has the right to hold on to the funds for a certain amount of time before they have to release the funds. So you just want to set the groundwork up so it doesn't extend out the time frame and the client doesn't forget what you presented to them, a few months before. So just understand that. When you set up proper expectations, also be aware that people are moving large sums of money. Of course, you guys out there in the audience, you're familiar with that. If you're a money manager, you're used to dealing with that. But again, if it sounds too good to be true, sometimes people are very suspicious of it. Of course, this is allowed in the tax code, but you want to make sure that you establish credibility, especially with someone if you're new to them or if you're new to this concept. So just make sure you establish the trust early on with both who you are, the products, and the carrier that's offering it. So if you have any questions about that, Brad and his team or myself, we can give you more details as to why this is safe to do, why it works, where in the Pension Protection Act it's located if you need to point your client in the right direction or their tax advisor. So with that, I'm going to come back in a moment. I'm going to show you this software just so you can see how to customize plan designs. We're really an open book when it comes to underwriting, when it comes to pricing. And again, if you have any questions as we go through, we will cover those at the end. So just another opportunity here to ask questions. So this is called Benefits Buddy. It's a plan design tool we built for agents to use so you can get a feel for how the plans work. It's not yet approved for client use. You really don't need it for client use. You just need it to figure out what's the best customizable plan design possible. And what I'm going to do is I'm going to set it up. We're going to start off with a plan. I'm just going to choose the state of Texas. I'm just going to type it in, or you can use the drop downs. We're going to do the 55-year-old male example that we did in our case study. And I used our middle rate class, which is called preferred. If they're healthier, about 35% of people do qualify for our preferred plus rating as well if you know that they're very healthy. Now, this sets up the planning process, and usually when you're planning for clients for long-term care and they're healthy, they're really not thinking they're going to use the plan, especially for quite a number of years. And from my actuarial background, I can tell you that typically the age that makes the most sense is 85. Some people like to use younger ages if the client's really worried about going on claim earlier. Some people have personal experience where their parents went on claim at age 90 or 95. You can use whatever age you want in the software, and it will recalculate the numbers for you. But what it's going to do is it's going to isolate this point of time. It's going to say if you pay a premium, in this case, let's say it's a $58,000 single premium, and you were to go on claim at age 85, this is how much total benefits you would have under the plan. And the plan that I started off with, but we can change this, is a 5-year plan with a 3% compounding of an initial $150 daily benefit. It's got the 90-day elimination period deductible on it as well. And on the right-hand side, you can see what the daily benefit will have accumulated to at age 85, which in this case is $364 when you compound 3% over the next 30 years, which is 55 to age 85. So it simply does the math for you, and it calculates your pool of benefits as $700,000. Now, the thing that I like about this agent use software is it immediately shows you, for the premiums you paid into the policy, how much total benefits, maximum benefits are possible. In this case, it's 12 times. You know, some people think of this in the hybrid space as kind of leverage. We call this the maximum benefit ratio, but simply put, it's their benefits divided by their premiums, 12 times protection. So we can look at different features and different facets to give you a sense of the value proposition. Again, in today's low interest rate environment, it's very hard to build a self-insurance fund legitimately to an amount of money that exceeds what you can do from insurance. And that's where you can show it as a better way to self-insure. Now, this is the traditional option. I'm going to show you also what the hybrid option looks like, but let's follow the process that we laid out, which is figuring out the funding source and the target premium. So in this case, there was $125,000 cash value in the annuity. So I'm going to set that up in here. I'm going to do $126,000 as a target premium. And what the software is actually going to do is it's going to calculate as close as it can get without going over what benefits will be available under the long-term care policy. And you'll notice the leverage will not change when you do the target premium. It's just going to scale up the benefits and scale up the premium kind of linearly so you can see how you can get more benefits. Now, in this case, it got to the maximum amount that we sell, $300 a day. But we can also compare this side by side with the return of premium option, kind of do that assessment and figure out what will it look like if we add the return of premium rider to this. So I'm going to do the return of premium rider so you can see, and that was kind of our $125,000 example, is it went as close to $126,000 without going over, and the software calculated that it's going to start off with $160 a day to get to this target premium. And what it's showing us is that there is 6 times benefits if they need long-term care, but if they don't need long-term care, that money goes back to their beneficiary as the return of premium. And if they change their mind, there's about $100,000, that's the 80% after the 4th year. And in this case, we just assumed age 85, so those are the numbers it's showing. So we did a traditional option, and we did a hybrid option using the same target premium side by side. So you can ask your client, do you prefer to have a solution where we're going to return the money to your estate or to your beneficiaries, and you get 6 times protection, or would you prefer for about the same amount of money, actually a little bit less, to get 12 times protection without the return of premium? Either way, you can do the 1035 exchange. And again, the gains that would have been taxed are part of the extra value proposition that's not even shown here. So I hope that gave you a little bit of an idea of how to use the software. It obviously does a lot of different things. If we take out the target premium, for example, and you want to see, well, if instead of doing a single premium, how much would this cost me if I did it as a 10-pay, you can simply select the 10-pay option, and you can see it would be about $6,000 for the next 10 years for a 10-pay. If you want to look at it as an annual pay, lifetime pay, well, that would be about $2,300 paid for the next 30 years, because there's 30 years until claim here. So again, you can assess what's the right price point, and more importantly, depending on the funding source, you might want to fund this annually instead of as a single premium. And you can do 1035 exchanges on other ways aside from a single premium as well. For example, let's pretend you have an annuity, or client with an annuity, and they're within their surrender period. You can actually do a 10% surrender-free withdrawal with most annuity products, and you might end up doing a 10-pay exchange because you want to maintain, not taking a surrender charge on the annuity, but you still can use that to fund long-term care. So there's a lot of different ways you can kind of mix and match this. You can do a single premium, with a orphan and a life insurance policy that has a small cash value that the client just doesn't want anymore. And you can buy cash for, an additional policy as long as it doesn't exceed initially $300 a day, which is the maximum under the policy. You can actually do kind of creative mix and match solutions like that too. So I know we've covered a lot of topics today. There's a lot of other things we can cover if you want to on a future webinar. Just let Brad and his team know what you're interested in. I hope this gave you some insight and some ideas and some clients that come to mind. But with that, why don't I open it up for some questions? And Allie, do we have anything on the line right now?
Yeah, there's one question. It was on the non-qualified 1035 opportunity. If ownership of the annuity is in a single name, say the husband, for example, can they get an annuity to an NGL LTC policy that will insure both jointly spouses, or would it just be for the husband?
That is a great question, and one we get all the time, so I'm glad you brought it up. And yeah, keep these questions coming. This is really good. It needs to be the same owners and same insureds. So if you have one husband that owns the annuity policy and they want to get joint coverage, you cannot do a 1035 exchange directly. Now, I will tell you, we did file a new product feature that's been approved, but we haven't yet released it to the market. So think of this for more towards the end of this year. We'll have it available in 38 states, which will allow you to buy two individual policies, and we kind of recreated the joint pricing effect. So we give each policy like a 35% discount, a big discount, and we give access to that third pool shared benefit rider. So if you have one or both of them with a 1035 exchange, you can move over one or both of their funds into their own individual policies. But today, in today's current state, you need a joint annuity with the same owners and same insureds to do a joint long-term care policy. That's why I use the single person examples today as well. But when we get to that, we can certainly look at joint examples if you're interested. Great question.
Oh, and Brad wanted to clarify really quick on his phone number. His the area code is 877-738-0294.
Okay, I'm trying to fix that, but I couldn't do it smoothly enough, so I'm not going to do it.
Oh, that's okay. Well, you're still talking. You're so sweet.
Interactive.
Thank you.
This is an interactive.
I know, we're all here. Yeah, it's good. I do have another question that just popped up. Any idea when the product will be approved in California?
Yes, actually, we're working very closely with the state right now, and we're making good progress. We're going to estimate that it's going to come out in the fall time in about 6 months. Could come out sooner than that, actually. But since we're going through the kind of the final stages of the question and answer, I don't think it's going to be delayed much further. So we should have this in California pretty soon.
And then another question that came through is, what concerns do you have for the future of the LTCi market?
You know, it's a very interesting marketplace for those of you that are familiar with it. It's kind of transformed itself a variety of times over the years. And what I've kind of discovered is that there's more and more long-term care planning options coming into the market. probably because the need is growing, and it's just not going to stop. I mean, if we look out there, there's 43 million caregivers in the United States today that are taking care of people for long-term care. It's a sad story, and almost everyone has that personal experience. So where the market's kind of evolved today is that the products are no longer commodities. They're actually more customized and complex, and they're all fits for different types of clients. So I believe that the current state of the market is actually the most valuable for people that know what they're doing, especially because you have traditional options still, which is great, and it's kind of stabilized where the carriers that are there are kind of sticking there. We actually have NGL, which is a new carrier, which is great news to see. And then you also have hybrid plans, which are getting more competitive, and there are new good options coming out with hybrid plans. You have life with long-term care rider programs. You have annuity with long-term care rider programs. You probably have 100 different solutions or more in the marketplace today. From my perspective, the more tools you have, the better off you are to finding something that's right for your client. At the same time, I think if you're not in this marketplace full time, it can be very difficult to navigate all the changes. What are all the carriers underwriting? What's all the carriers' value propositions? The products are changing all the time. So frankly speaking, I think the best person to be today is kind of a long-term care expert to take advantage of the opportunities. I think Brad and his team provide that expertise for you, which is why it's good for you to reach out to them. But I also think, if you're an advisor out there and you're looking for a niche focus, and I think it's good to be a specialist because it allows you to market yourself. Long-term care is a pretty darn good specialty to have today because there's very few people who know how to do it well, and there's so many opportunities. And almost every client needs the plan. So it's just about, finding people, identifying the funding sources like we did today, and finding the plan. So I actually see so much optimism for the long-term care market. The negativity is going to be there because the past products, are going to have rate increases because, frankly speaking, they were really, really cheap. They were really inexpensive. And unfortunately, the clients, it feels like a bait and switch a little bit for the clients, but the reality of the world is that almost everyone pays the rate increase because the value proposition is like unmatched, from what you bought before. So it's more of a perception thing, and you can even reduce your benefits to keep your premiums level. So I would say there's negativity out there about long-term care, but it's not necessarily placed in the right direction. And I'm very bullish on the long-term care market, or being in the center of that, because no one's going to solve this for your clients. The government doesn't seem like they're going to step in. They're going in the other direction. And there's various tax advantage ways to do it. Those are kind of exciting because the government's kind of encouraging people to get their long-term care plan because they're subsidizing it in various ways through tax advantages. So I hope that answered the question, but I'm a big believer in this, obviously. And if you are kind of a believer like I am, again, think about your stories and sharing that with your clients, because in the past, the biggest issue is building awareness about the need. You don't really have to do that as much. As long as you hone in on a particular story, it'll become very clear to everyone involved what exactly you're trying to do. So that part of the equation is actually not as challenging as it used to be.
Awesome. Another question popped up is, it says, is 1035 available for a joint life policy in an ILET for LTC benefit to the grantors?
Okay, I'll give it a caveat, and that is more advanced thinking. And I like where you're headed with this, but I'm not a tax advisor, so I want to be careful about specifically giving advice on any trust situations. It's going to be all specific to the tax advisors. Now, when you do traditional long-term care without the return of premium, you're only getting the benefits for the long-term care. And of course, they're going to get paid to the policy owner, however you assign that. And you can assign an alternative policy owner for the benefits, which could be a trust. If you do the return of premium benefits, just make sure you contact a tax advisor for how to treat that. The basic return of premium is not going to have any type of gain on it because it's just simply a return of the premiums paid into it. However, if you're getting a tax advantage on the front end, you do have to make sure that you get some tax advice if they end up getting a residual return of premium benefit on the back end. It's technically a long-term care rider. It's not a life insurance feature, but you do want to make sure that you consult with their tax advisors. Different tax advisors actually treat the return of premium differently, but in no case that I've seen is it treated any worse off than if you had to pay it initially. So it's like you're deferring the tax for a longer period of time, and then you pay it out of the return of premium later. That would be kind of a conservative way of treating it. But again, that's just this actuary's opinion and not a tax advisor's opinion. So you can do some very interesting things with ILITs and different, I'll call it advanced planning mechanisms. But you probably need to be in that marketplace and have the right advice for doing it.
Awesome. So I'm not seeing anything else popping up right now as far as questions go, but we have Brad's contact info up there, and you can always ring him in if you do have any other questions. Brad, do you have any closing statements?
I do not. Thank you very much, Mark. That was fantastic.
Okay. One more thing I will mention is there is a handout before you leave. Feel free to download on the right-hand side. There's a flyer if you want to just download the 1035 exchange concept so you can review it later. That might be a good way to do it. But thanks everyone for attending today. I appreciate it.
The presentation, the webinar will be available on the advisor resources portal. I'll email that link out to everyone. So if you have somebody maybe in your office that missed it, or if you wanted to rewatch, and also there'll be any supporting documents for download there as well. So thank you everyone for being on the call, and we'll look forward to talking to you next time. Bye everybody.
Thank you.